In about 30 years, a stranger is going to be living inside your body. He'll have your face, older, your name, your knees, your debts, your regrets. And here is the disturbing part. Right now, your brain does not believe he is you. That is not a metaphor. Put someone in a brain scanner and ask them to picture themselves decades from now. The brain's "this is me" signal fades and is replaced by the exact pattern it uses for a total stranger. So when you don't save, don't plan, don't look, you are not lazy. Your brain is refusing to do a favor for someone it believes is not you. And one market is built entirely out of that stranger's world. The bond market. One number inside it, the 10-year Treasury yield, sets your mortgage rate, the interest on your savings, and the debt your government carries. Over $130 trillion, larger than every stock on Earth combined. Bonds are the machine pricing your entire future, and the one market you were neurologically designed to ignore. Two men are going to walk through this video. Adam and Noah. Same salary, the same paycheck, every month for 30 years. One of them looked at this market. The other never did. And at the end, the gap between them is $750,000, with not $1 of it lost on a bad bet. If you have ever seen a mortgage rate and wondered who decided that number, that question is why this channel exists. Subscribe and you get the machinery taken apart one piece at a time. Today we introduce you to the stranger who inherits your money and the market already deciding how rich he gets to be. First, what this market actually is. A bond is a loan. When a government or a company needs money, instead of a bank, they borrow straight from investors and hand over a promise. Your money back on a set future date, called the maturity, plus a fixed payment each year, the coupon. Notice that word, maturity. A bond is a promise about the future. The whole market is. And the scale is hard to believe. Every stock on Earth, combined, is worth about $127 trillion. The bond market is bigger, over $130 trillion, the single largest market that exists. The biggest borrower on it is the US government, now more than $38 trillion in debt. Just the interest runs close to $1 trillion a year, roughly $2.9 billion a day. The government now spends more servicing its debt than on its entire military. So why does almost no one look at the market that runs all of this? The answer is not laziness. It is the same glitch from the very start of this video, and it has a name. Economists call it present bias. Your brain discounts the future on a steep curve. A reward today feels enormous. The same reward in 30 years feels like almost nothing. And bonds are pure future. 10 years, 30 years, decades of compounding. To a brain that can barely feel next month, a market made of decades is almost invisible. This is the difference between Adam and Noah, and it is not intelligence. Adam's brain treats his 60-year-old self as a stranger, so protecting him never feels urgent. Noah does one unnatural thing. He makes that stranger real. More on how at the end. First, look at what the blindness costs. Now, the one rule that moves the whole machine. It is a seesaw. When interest rates go up, the price of existing bonds goes down. Always. Watch it. You buy a bond for $1,000, paying 3%, $30 a year. Months later, new bonds pay 5%, $50 a year. Try to sell yours. Nobody pays $1,000 for $30 when they can get $50. To move it, you drop the price to about $600, the point where $30 finally equals a 5% return. Your safe bond just lost 40%, and you did nothing wrong. The first bill arrives here. When Adam takes a 30-year mortgage, he thinks his bank sets the rate. It does not. One bond does, the 10-year US Treasury. The bank's logic is cold. Why lend to Adam for 30 years when I could lend to the government for 10 at basically zero risk. So it takes the 10-year yield, say 4.5%, and stacks about 2% on top for Adam's risk. 4.5 plus 2. And his mortgage is 6.5%. He never sees that math. The bond market just priced his home. Watch how little it takes. Same $400,000 house, 30-year loan. A 1% move Adam never watched adds $97,000 to his house. But that is the calm version. Now the real invoice. In January 2021, the 30-year rate hit a record low of 2.65%, a payment of $1,600 a month. By October 2023, the same rate had climbed to 7.79%, and the exact same house cost $2,877 a month. Same house, same man. The bond market moved and sent Adam a bill the size of a second mortgage, for nothing. And because it played out over years, not seconds, his present bias brain never once felt it happening. Now the part that should scare you, because it hit the money people thought was safest. The old rule: as you age, move from risky stocks into safe bonds. 60% stocks, 40% bonds. Bonds were the seatbelt. In 2022, the seatbelt failed at the same instant as the crash. The Fed raised rates from near zero to over 4% in 9 months, the fastest in 40 years. By the golden rule, bond prices had to collapse. Stocks fell 18%. But bonds, the safe part, fell 13%. The worst year for the main U.S. bond index since it began in 1976. The safe 60-40 portfolio lost 16%, its worst since 1937. And long-term government bonds, the safest of all, dropped almost 40%. One word on every bond fund's fact sheet separates the people who understand bonds from the people who merely own them. Almost no one reads it. Duration. Duration tells you how much your fund drops when rates rise 1%. That is it. Duration of 6 loses about 6% per 1% move. Duration of 17 loses 17. Same move, completely different damage. $55,000, hidden in a number on page 4 of a document nobody opens. And one last thing worth knowing before we get to what all of this costs your future self. There is a difference between a bond and a bond fund. Hold an individual bond to maturity, and the swings in between do not matter. You get 100% back at the end. But a bond fund never matures. It is repriced every day. In 2022, those losses were not on paper. They were locked in. Noah knew which one he owned. Adam did not. And that was everything. One more thing, because it confuses everyone. Were bonds not supposed to rise when stocks fell? Normally, yes. Scared money runs to government bonds, flight to quality, and cushions the drop. But in 2022, the cause was rising rates, and rising rates poisoned stocks and bonds together. The seatbelt and the airbag failed in the same crash. And the decade before it? Bonds paid almost nothing, so every dollar was forced into stocks. There was, literally, no alternative. Traders called it TINA. That whole bull market was, underneath, a bond story. It always is. This market also predicts the future better than almost any expert, with one shape: the yield curve. Normally, longer loans pay more. A 30-year pays more than a 3-month, because your money is tied up longer. But sometimes it flips. Short-term bonds pay more than long-term. That is an inverted curve, and it means the market is betting the economy will slow so hard that rates must be cut. How good is it? Before every one of the last 10 U.S. recessions since 1955, the curve inverted first. 10 for 10, the most watched warning light in finance. It is not a crystal ball. The inversion that began in 2022 was the longest in history and still has not produced a recession. So it can be early, and it can be wrong. But notice where the warning light lives. buried in the quiet bond market. So the people staring at the loud market never see it flash. There is a second, faster one beside it, the high-yield spread. Companies can go bankrupt. The government cannot. It prints its own money. So risky firms pay more to borrow. And the gap between those two rates is a live fear gauge. Narrow means calm. When it suddenly widens, big money is bracing for layoffs and defaults, often weeks before the headlines. Adam reads the headline. Noah reads the spread. So come back to the stranger, the 60-year-old wearing your face. Here is what your present bias actually costs him, and the number is larger than any mortgage in this video. Two people invest the same $500 a month. Adam's brain keeps whispering, later, that's future me's problem. So he starts 10 years late. Noah starts now. Same monthly amount, same 10% return. At 65, Noah has $1,130,000. Adam has $379,000. The gap is $750,000. And Adam never made a single bad investment. He lost it by treating his future self like a stranger for 10 quiet years. Every later was a small robbery of a man who has your face and cannot fight back. That is exactly what Noah does differently, and it is the same move he makes in every part of his life. Not willpower, but monitoring and friction. 3 concrete steps. 1. Make the stranger a person. Noah picks the age, pictures the face, even keeps an aged photo. Then he automates one transfer on payday before his present self can vote. The decision is made once by the version of him who cares, so his impulsive self never gets a say. 2. Stop donating your cash to the bank. The average big bank savings pays 0.38%. A 3-month government T-bill or high-yield savings pays around 3.8%. Same safety, government-backed or FDIC insured. On $50,000, that is $190 a year versus $1,900. 10 times more, same risk. 3. Glance at the one number. Noah keeps that little notebook. Once a week, 30 seconds, he writes down the 10-year Treasury yield. Not to trade, just to see the machine pricing his mortgage, his savings, and his stranger's retirement. Not to predict anything, just to see the machine. The bond market is the ledger of your future. It never spikes, never thrills, never gives your brain a reason to look. That is exactly why the person who looks wins. You are seeing the one thing everyone else is wired to ignore. So open a tab and type 10-year Treasury yield. Read the number. That is the price of the stranger's life, and it is the first favor you have ever done for him.